Where is that at? There we
I've
go.
literally been doing postcards. Like,
Oh my goodness.
yeah, I was like
Yeah.
wishing my daughter was here to put the stamps on it.
That would be ideal.
Load it up and go down it. Hey everyone, this is Ashley Jamerson coming to you from Ashley Lambert Realty, and I am with Cole Schwietering of Movement Bank. He is an awesome lender that I've worked with for at least 3 years now, right?
Yeah, I think so.
At least
flies, right?
Yes, he's helped a lot of my clients. He's currently helping clients right now. It's almost time to close. So wanted to get him on a Zoom call because that's how we do things now. Wanted to get him on a Zoom call and talk about FHA versus conventional loans. I have a lot of people who are first-time home buyers, and they obviously have been told about the FHA loan product, and they don't really know the difference, know the pros and cons. And I like to stay in my lane. I do real estate, write contracts, show property, negotiate. But Cole is the go-to guy for lending. So I'm gonna let him explain his lane because I have no idea half the time what to tell my clients. So I guess first and foremost, like, who can apply for an FHA loan and who can apply for a conventional? Like, what are the requirements, things like that?
Yeah, awesome. Well, first and foremost, thank you so much for having me back on again. I really enjoy these videos, so thank you there. But we'll get into the nitty gritty. So really, who can apply? So with the FHA mortgage, here are kind of the standards, if you will. Typically, FHA is going to be for individuals with low to moderate income, with credit score requirements that are not as strict as conventional. So with an FHA mortgage, we could potentially qualify somebody all the way down to a 620. Mm-hmm. Now, in a normal environment, there are times when we can go down to a 580 minimum credit score. But of course, now with everything that's going on with COVID, there is a slight overlay there. But it's always been that anytime somebody's under a 620 credit score, mm-hmm. then we have to manually underwrite the file. Now, I won't get into too much on what that is, but it's a little bit tougher to manually underwrite than it is to do the traditional underwriting. So that would be the minimum credit score requirement for an FHA mortgage. And then for a conventional mortgage, they're going to require a little bit higher credit score. Mm-hmm. Now, there really is no set in stone. I think technically you can go down to a 620 with a conventional loan.
Right.
However, let's be honest, it's going to be very, very tough to get a conventional approval under 680 if you don't have compensating factors. So that's why.
Factors. What would that be?
Yeah, good question there. So compensating factors would be low debt to income ratios, mm-hmm. and then lots of reserves.
Okay.
So nice 401k, tons of reserves. But it can still be very tough, even if you're the perfect clientele, right. To get that approval under 680. So that's why I put that 680 there. Mm-hmm. However, it is possible to potentially get a conventional approval lower.
Okay.
Yep. And then to backtrack real quick, because I think we were talking about requirements. So with an FHA mortgage, one of the nice things about that program is they allow for you to go a little bit higher on the debt to income ratios. Mm-hmm. So technically with an FHA mortgage, you could go up to 55.99% on your debt to income ratio. And then with a conventional mortgage, you're a little bit more conservative. So that's typically a cutoff at 49.99%.
Okay, cool. So the FHA is government backed. How does that play into, I guess, like appraisals? I know that like on the real estate side, this past weekend, there was like over 30 showings on one of my listings. We had 15 offers, and my client was like, help me select the best offer. And the government-backed loans like FHA and VA, unfortunately, the appraisal is a little bit more strict. How do you see that like playing out, I guess, with conventional?
Yeah, no, that's a great question. Unfortunately, it is a little bit more strict. Mm-hmm. Usually, if a property is in rough shape, or not even if it's in rough shape, right. but if there are some slight issues, potentially that can be picked up on an FHA appraisal, whereas mm-hmm. a conventional appraisal is probably just going to overlook that. Because the main thing, as you know, being a real estate agent, main things you want to look for on an appraisal is the value, and then if the property is as is or subject to.
Right.
So with an FHA mortgage, here's like an example I've had in the past. I had a buyer who was doing an FHA loan, and there was a slight hole in the siding of the house. And that appraiser picked up that had to be replaced before they would mark the appraisal as is. So then the appraiser had to go back out there, which is an additional fee, just to make sure that the siding had been fixed. So that's just a slight example.
The buyer, and typically the buyer's agent will request that as a repair.
Correct. Yep.
So it's a little bit difficult because like you definitely want to help for some home buyers who are using FHA, and definitely help our veterans. But from a seller standpoint, they want to sell the home for like the highest net, the least amount of stress. And sometimes these appraisals can be, and it's just an opinion of a person. So you can send out 3 appraisers and they all come back with 3 different answers. But that FHA appraisal sticks to the property for how long?
I think, I don't want to get this wrong. I think it's 120 days.
Yeah, I think it's something.
I could be wrong, yeah.
Makes it so the seller is like, I'm really going to just lower the price if they do go with an FHA or VA buyer. So
yes, exactly. I was looking real quick. Let me see if I can pull it.
While you're looking that up, what's the maximum purchase price for an FHA versus a conventional?
Yeah, so I think what we want to focus on is actually the maximum loan amount, because that'll kind of determine the maximum purchase price. So for FHA here in Charlotte, in really most areas, that maximum loan amount is going to be $331,760. So $331,760.
Yeah,
so yes,
it's well above the average price in Charlotte. So,
which is nice because it's increased pretty much every year that I've been doing this. So back in 2019, it was lower than that. So it seems like it's adjusting based on where the markets are going, which is favorable to the buyer. Now on the conventional side, the maximum loan limit is quite a bit higher. It is $510,400. I know that's a little random number, but that's what
there's always a reason to these numbers.
That's right. But it allows for more flexibility. And then anything over that 510,400 loan amount wise, you're starting to play in the jumbo territory, which I know we're not going to talk about today.
Are those back?
No, jumbo loans are, well, they're there. They're there, but they're very particular about the buyer. You're really going to need low debt to income, and you're going to need a lot of assets, and then probably the ability to put 20% down to get a jumbo loan right now.
Okay. Is it safe to say that an FHA is basically like your first home? You build equity and you roll that into your conventional loan. So is it also for like a second purchase typically?
Yeah, I think FHA is a great program to get into. Now, do you want to stay in an FHA mortgage forever? Probably not. If you have the ability to increase your credit or decrease your debt, whatever reason you had to go FHA in the first place, if you have a chance to kind of resolve that, then it would make sense to potentially refinance into a conventional loan down the line. But we also would want to like look further into your home ownership goals. Because if you're not really planning to hold the house for that long, then it wouldn't make sense to refinance. Just on your next mortgage, you would maybe want to look into a conventional if it's a possibility.
Okay. Interest rates are pretty similar between the two, like if all things remain constant with the buyer?
Yeah, so actually pre-COVID, typically it was common to see rates for FHA mortgages to be a little bit lower. Now, I'm not going to get into the nitty gritty of everything that was going on the back end with all the economic impacts, but now it's kind of common to see them very similar. It seems like they've kind of leveled out. And that has to do with the risk of the loans and the investors' demands on the back end.
Okay. A lot of people, they do the online research, they run into these videos and they have a lot of questions about mortgage insurance, private mortgage insurance. Who does it protect? And I'm like, it doesn't protect you, it protects the bank from you. And so they're a little bit thrown off by that. But when it comes to FHA and conventional, what is the difference when it comes to the PMI?
Yeah, no, that's a great question. So with a FHA mortgage, there's really 2 types of mortgage insurance that apply to the loan. The first one is what they call upfront mortgage insurance premium. So that's a 1.75%. Now, that particular mortgage insurance gets rolled into the loan amount. So with an FHA mortgage, you can put 3.5% down. So that equates to 96.5% financed.
Mm-hmm.
Now your base loan amount would be 96.5%. However, after the upfront mortgage insurance premiums rolled in, it's going to be higher. So a lot of people end up getting their loan estimate and they're like, well, hold on, this doesn't equal 96.5%. And that's because the upfront mortgage insurance premium is rolled in.
Mm-hmm.
Now, there's also a monthly PMI feature on an FHA mortgage. They call that pretty much the annual mortgage insurance premium. So they take an annual amount, divide it by 12, and then it equates to a monthly payment portion.
Right.
And that is fixed for FHA. So all buyers, regardless of credit score, are going to get the same PMI amount just based off of the loan amount.
Mm-hmm.
Yep. So that's kind of how it works for FHA. And then, sorry to backtrack, but it also stays for the life of the loan.
Yeah,
it
used to fall off like back in the day, and like now it's forever.
Yeah, so I think, because I was doing a little bit further research back into it, I think if you have the ability to put 10% down with an FHA mortgage, then it falls off after 11 years. I don't know if that was an older rule, if that still applies, but typically anybody who's doing an FHA mortgage is usually doing 3.5%. I think I've maybe ever done one that's put more than 10% down. So yeah, for most cases, the PMI will be on there for the life of the loan.
And then to get rid of it, they would have to refinance into a conventional product.
Correct. And then that'll segue us real quick into the conventional side. Mm-hmm. So with a conventional mortgage, typically it's going to require PMI, private mortgage insurance, if you put less than 20% down. Mm-hmm. Now, there are ways to structure the mortgage to where there is no PMI with less than 20% down. However, it's getting priced in somewhere.
Yeah.
Whether that's the interest rate or upfront cost. So in a normal situation, you will have PMI with less than 20% down. Now, the cool part about that is that PMI, private mortgage insurance, will fall off once you reach 20% equity in your house or 80% loan to value. So that's the nice positive of a conventional mortgage. And then two, unlike FHA where it's a fixed rate, with conventional mortgages, that PMI amount is going to be really based off of how much you put down and your credit score. That's what drives that amount. So somebody who's probably under 700, sub 700 with a conventional loan, that PMI is not going to be pretty because you're going to have to price that risk into it.
Okay. And that's what it basically is. They don't want a repeat of 2009, 2010. So they built in these insurances for themselves. Mm-hmm.
Correct. Yeah. And that kind of leads you back to, unfortunately, this PMI amount that you're hearing does not protect you as the buyer. It protects the lender if you were to default.
Yeah. And I've had buyers look at the disclosures and they're like, why am I paying two different insurances? And I'm like, well, one is for trees hitting your house and one is for you not paying for the house. So
that's correct.
Yeah. What other questions do I have? What haven't I covered? Well, I guess this is a good one. Different scenarios. I've had people who have had really good debt to income ratios and really like a lot of money owed. Not a lot of money owed, but maybe they're like not current on paying student loans. And they were switched from an FHA product to a conventional product because FHA is government backed and the student loan was like a Department of Education type thing. So what other scenarios, if someone is approved for both and can do both, like what are some reasons why they would select conventional over FHA or FHA over conventional?
Yeah, well, I think you just touched on one of the biggest issues with an FHA loan is the student loans. Yeah. We see that a lot. So FHA is by far the stricter program when it comes to student loans. So the underwriting requirement that all lenders are going to have to abide by is we have to use, with an FHA mortgage, we have to use either what's reported on the credit report for your payment or 1% of the outstanding student loan balance, whichever one is higher. So typically it's going to be in the 1% of the student loan balance, which is higher. And that's a deal killer for a lot of individuals, unfortunately. Yeah. Now, the conventional mortgage is a little bit more what's the word I'm looking for?
Understanding.
Understanding. There you go. They're a little bit more understanding when it comes to student loans. So with a conventional mortgage, we can use what's either reported on the credit report or your income-based repayment plan. So if we could show that your income-based repayment plan is, I don't know, $100, then we can use it. We just got to be able to document it. Now, here's one of the biggest questions right now with the CARES Act. A lot of people have student loans that are in forbearance or deferment right now. I think they've stuck everybody in forbearance with the CARES Act with student loans. So if it's reporting as in forbearance or deferred on the credit report and there's a zero or there's no payment shown, then it gets tricky. We either got to use 0.5% if we go Freddie Mac, which is a version of conventional, or 1% if we go Fannie Mae, which is another version of conventional. So at that point, we would probably maybe advise to maybe get you on an income-based repayment plan. Take those things out of forbearance or deferment and get them on an income-based repayment plan.
If they're already under contract, is that something that can be done quite quickly?
Yes, I believe so. I think they can contact the servicer. I've had somebody who's done that, and they can get something on letterhead from the servicer saying, all right, if you take it out, this will be your payment.
Okay.
Mm-hmm.
Okay, so the big takeaways that I got was FHA is government-backed, first-time home buyers. If you have student loan debt, still reach out to you, and you will help them compare and contrast. One of the big hurdles that I have with a lot of people that contact me is they want to use their credit scores from MyFICO, Credit Karma, the one score that Wells Fargo gives you. Why can they not use that, and why do you have to pull their credit?
Yeah, no, that's another $1 million one.
And it's like it's so hard because they're like, I've been monitoring, I've been fixing my credit, and I think I'm ready. And I'm like, you gotta, call Cole, and he's gonna pull your credit. And they're like, oh, I'm gonna hold off. I'm like,
yeah,
no, you gotta do it. You gotta do it.
Yeah, no. So really the main point is because Credit Karma, Wells Fargo's app, the credit card apps, us, we all use different credit reporting algorithms.
Mm-hmm.
The mortgage industry has a particular credit reporting algorithm that we all use uniformly. So that is going to be different than what you're seeing on Credit Karma. So here's an example. Somebody who has paid collections,
mm-hmm.
they've been taken care of. Credit Karma is not going to reflect that in their score. Now on the mortgage side, when we pull that paid collection is going to show up, and it's going to carry a little bit of weight on your credit score. So that could be an example of why we'll see a different score than you will on Credit Karma. But I've also seen situations where the Credit Karma score is actually lower than what we pull on the mortgage side. So it really just depends on somebody's credit profile and how that could come back. But guys, I think it's important to know that by pulling your credit is not the end of the world.
How many points is it? Like if you pull, it's hard to say because of whatever their credit is at currently, but on average, is it like 5 points, 10 points?
Yeah, so that's kind of a loaded question because, really just depends on somebody's credit profile. Everybody can kind of take a little bit different hit. Somebody with great credit score is probably only going to hit them a few points, like 5, 6, 7 points. I have seen people's drop as little as 10 points.
Mm-hmm.
But what's nice though is we pull the score prior to the drop. And also too, you have 30-day grace period to be able to kind of shop around lenders and look at other situations. So it's not like every time that credit gets pulled in the mortgage industry, it's like, hard hit. It will show up as an inquiry, but it's only going to hit you one time.
Mm-hmm.
So that's important to know. And guys, it's not like the credit card inquiries or auto shopping inquiries. Ours do not hit your score as hard as those. And you got to be careful too, because sometimes they'll pull multiple times and each time it'll hit.
It'll bring you out like a list. You can select one of these. I'm like, what?
So that is the nice part about the mortgage industry. They realize that, hey, look, this is one of the biggest purchases you're ever going to make, probably the most money that you're going to borrow at one time. You need to, they encourage you to look around, if you will. So that's why they're a little bit more generous with those hard credit pulls in the grace period.
Do you know how long it'll take for it to bounce back-ish?
Yeah, that's another tough question. As you know, I've said this a million times, I'm a mortgage expert, not a credit expert. But if I had to imagine, by making a few on-time payments, a few months of on-time payments, I'm sure your score is going to bounce right back in a month or two. But that's different for everybody because everybody's got a little bit different credit scenario.
Credit situations. Sometimes the husband's credit score is much better than the wife's credit score. Together they make great income, maybe separately not the same income, different scenarios like that. If they're married, can the income from the household be used towards buying the house, or is it just the person on the loan?
You're a mind reader. I think I just had this situation yesterday. No, so both buyers have to be on the loan to be able to use the household income or to use both incomes.
Mm-hmm.
So I've seen scenarios like you just mentioned. Let's say the husband has a little bit better credit score, but he makes less income than the wife.
Mm-hmm.
Well, then we're kind of in a pickle because the person who carries the most income is the one that doesn't have the great credit score.
Mm-hmm.
Because regardless, if we have two people on the loan, we have to go off of the lower score. That's going to be the decision score. So
the lower score, you don't average them together?
Lower score. So as we talked about before in the scenario, we can only go down to a minimum of 620. So let's say that the wife had a 615, husband had a 650. Well, we'd be in trouble there. Unless we can help get the wife's credit score up above a 620, we really can't have her on the loan. Mm-hmm. So that is the tough part about how the credit works.
Mm-hmm. Okay. I mean, there's so many different scenarios, and some people will ask a friend, well, this wasn't the situation with me. And I'm like, well, you need to get all their business. If they're telling you this piece, get everything around it. Like if they use a down payment program, whatever, if they know what they did before you get advice from other people. What are some other situations? Yeah. I mean, I've had mattress money recently where that's how they were saving money. They were not necessarily a mattress, but it was like money in a shoebox. How does that play with conventional and FHA if they suddenly dropped $15,000 in their account? Is that something I can write a letter of explanation for?
So I'm glad you mentioned that. So you're hearing it here first. Do not deposit any large sums of cash in your bank account. It is definitely going to throw a loop in the underwriting process. Mm-hmm. So here's how it typically works. For an FHA mortgage, anything over 1% of the loan amounts mm-hmm. is considered a large deposit. So it's got to be sourced. Well, guess what? You can't source cash. So it gets a little difficult there. Mm-hmm. Now with a conventional loan, the large deposit rule is 50% of the gross monthly income being used. So if somebody's making $6,000 per month, then anything over $3,000 we would have to source going into the bank account. Mm-hmm. And I don't know if that's industry standard, but I can tell you that's movement standard. So I would imagine that most people would be similar.
I'm glad you mentioned that's movement standard. I have people that will say, well, I don't want to shop around. What am I looking for when I shop around? Or why did I get approved for more money with this lender than that lender? Why is that? And if they are approved for more, but they do want to work with, for instance, you, how does that, does it like a matching, or do you ask for the fee sheet? Do you really want to know what's going on there? What's the differences?
Yeah. So, first and foremost, when somebody comes to me and they've mentioned they've been working with another lender or they're looking to change, mm-hmm. I will first and foremost ask them, what did the other lender, what were they telling you? What kind of program are they trying to pair you with? Where was the issue? And then we kind of tackle it from there. I mean, there are lenders out there. Sometimes the banks will have their own portfolio of products. So State Employees Credit Union is mm-hmm. a perfect example. They have this really cool 100% finance program. However, we're not going to get into the nitty gritty of it, but they have a lot of minimum requirements, credit score, mm-hmm. debt to income ratio. So what happens is a lot of people will go through there and then all of a sudden they hit some kind of roadblock. So in that situation, that could be a quick fix, but it could just be too that the loan officer is just totally approaching it the wrong way. It's just not the ideal program to be in. And there's got to be there just needs a little bit of a workaround. And so that's what my team and I kind of pride ourselves in is problem solving, mm-hmm. trying to figure out which program is going to fit you best for your home ownership goals.
Okay. Because the stuff I hear on my side, I'm like, the money's coming from somewhere. They're not just going to give you 9 times out of 10, they're not just going to give you free money. Is Movement Bank a servicer yet? Are you guys a servicer now? I heard that you might have. Are you?
No, so movement mortgages. So that'll kind of just get me into kind of the difference between the two, not to confuse everybody. You got movement bank and you got movement mortgage. We are under the same umbrella. The bank was pretty much started to be a full service bank to be able to help individuals more than just mortgages. So I am at the bank though to do residential mortgages. But however, pretty much we are a broker for movement mortgage. So pretty much everything goes back through movement. So under the umbrella, we do have a servicer. Pretty much movement mortgage is going to be servicing the loan. So everything is uniform and it's really easy to access your account and do everything from the servicing perspective.
Okay. I think that's all of my questions.
No worries. Well, I got a few other highlights that I just realized that we probably didn't touch on. So I think at one point I did mention minimum down payment requirement for FHA is 3.5%. For a conventional mortgage, if you are a first-time home buyer, or if you make underneath 80% of the area median income and where you're buying, then you could potentially put down as little as 3%.
Okay.
If you are not a first-time home buyer and you have higher income, then you're probably going to need to do a minimum of 5% with a conventional loan. But one of the biggest myths is that you have to put 20% down, and that is not true.
That is a huge myth. I hear that a lot. Like they don't even think conventional is an option for them.
Yep. So that's one thing there. And then the other one I wanted to address as well, with both programs, gifts are acceptable. So for instance, if you have a family member who's willing to help out, speak with a loan officer first before transferring any money. Because last thing you want to do is a sourcing mess. Yeah. You want to make sure everything's done correctly. So definitely consult with a loan officer on that before, but that's nice. It doesn't all have to be your funds.
Will that family member have to give their bank statements to show where they got the money from?
Good question. For FHA, it's a little bit stricter on gifts. So with an FHA mortgage, yes, we would have to see the money leaving the donor's account. So sometimes that's a deal breaker for people because they don't want to share their personal information. So FHA is a little bit more difficult on that. We're not trying to dig through their whole life. It's just showing those funds leaving the account, and that's about it. Now with conventional, it's very easy. If you do it through the form of a personal check, then all we have to do is show a copy of the canceled check, and then that fund's entering the borrower's account. So it's much more straightforward. And then in both situations, the donor will have to sign a gift letter.
Yes, basically saying that this is a gift, I'm not repaying it, it's like a legit gift.
Correct. Yep. That's ultimately the verbiage of it.
Yeah.
Yep. And then what else did I have on here? With both programs, we won't get too far into the weeds here, but both programs do have a renovation option available.
Oh, don't get weed.
Yeah. So that's something that, reach out to me if you want to talk more on it. And maybe we could do a video on that sometime as well. So we won't use it for this purposes. I've done them before,
but some people, it still has to appraise in the future. You can't make a little cottage into a mansion.
Correct. And then one of the biggest deal killers, and we'll get off the subject, is people want that money to do the work themselves. It does not work like that. There's got to be licensed contractors involved. If you can find me a bank who's willing to give you X amount of money for you to do the work yourself, let me know.
Or your cousin that's not licensed.
Correct. And then 2, condo financing, depending on where you're at. Here in Charlotte, condos are becoming more and more relevant with the city life, expanding. With FHA mortgages, condos are super duper difficult to get approved. With a conventional, condos are a lot more straightforward and easier to get approved. So that would be a key difference. If you're looking at FHA, you probably want to look at your traditional housing, your townhouses, and et cetera. So conventional is a little bit more lenient on all of that. And also too, with FHA mortgages, they are a little bit more forgiving on past credit issues. So for instance, what I mean by that is like bankruptcies, foreclosures, negative derogatories like that. The seasoning periods are shorter with FHA than they are with conventional. Yep. And then let's see, last but not least, there was one other one that I figured we'd touch on real quick.
So it sounds like it's easy to get an FHA mortgage because they're a little bit more forgiving, but the requirements later on, like on the house that you decide to purchase, is a little bit more difficult because it is government backed.
Correct. Yeah. So that's one of the nice things about it being government backed. You know, they can take on things that are slightly a little bit more risky, but you're right. I mean, anything that's a little bit more risky by nature is going to require more paperwork, sometimes stricter requirements, and et cetera.
Signing that same FHA addendum 4 times.
Yep. You're right there. And then too, we just talked about the appraisal ordeal here, or before we kind of hinted at that. So I did verify that it sticks with the property for 120 days. So it doesn't stick with the borrower, it sticks with the property.
Right. So that means that the seller can't say, I'm not going to sell you this house for 180. I'm going to take it back and relist it at the original 200. They can't sell it to another FHA borrower for 200. They have to stick to that 180.
Correct. Yep. Conventional is a little bit different on that.
Yeah. That's why sellers like conventional, because they can say, well, you knew you were offering more, like, so pay the difference.
Yep.
So there's no FHA addendum or addendum that has to say that you lower the price. So that's why sellers typically like it a lot better.
Yeah, no doubt about it. But I think that covers most on my end. I think that'll at least give everybody a good idea of the key differences between the two. You know, if anybody's got unique situations, you know, feel free to reach out to me, and we can kind of dive into which program would be better. There are times where you may qualify for a conventional loan, but it might not make sense.
Right.
And so that's stuff that we're going to look at, because if you're in below a 700 credit score, it very well, from a mortgage payment scenario, could make sense to do an FHA versus a conventional, because you're going to be saving money each month. Correct. Yep.
Okay. Well, I definitely appreciate you chatting with me today, because this is, whenever somebody has a question about it, I'm going to send them the video. Or I'll just tell them to call you. You're really good at answering your phone and communicating with our clients. Like, they love you, so it's really cool. I'm going to put all your contact information below. If they were doing a loan application, is your loan app website Closings with Cole?
Yeah, so actually I did closing and closings, so that way if anybody types it wrong,
that was smart.
We'll probably end up at the right place.
I'll put all of your contact information below so they can start the process very easily. But yeah, again, thank you so much, and we'll definitely connect probably within the next 30 minutes, because I have questions about a file.
Yeah, no, that sounds good. Reach out to me.
Okay, awesome. Thanks so much.
All right, thanks. Have a good one, guys.
You too.
Bye-bye.